Good evening, everyone. So we're going to get started. My name is Kate Kendall. I'm Executive Director of the National Center for Lesbian Rights, based here in San Francisco. And I really appreciate you being here tonight with some very esteemed folks to try to make sense of what is a pretty complicated situation. And the complication arises for several reasons. One of the key reasons for the complication, as far as I'm concerned, is this is how complicated it is when you try to maintain inequality. It's kind of a mess. So if we fucked it up for them, that's fine with me. Because obviously this is a house of cards that at some point has to collapse, and there has to be some coherence to it. And our presenters tonight will try and talk about and maintain that coherence. But even as we feel a bit frustrated about where we are and how far more we need to go, and that we aren't quite sure what we're supposed to do with all of this, we can't help but recognize that sort of in the hierarchy of oppression, we're doing pretty good in California. And, just a couple of weeks ago in North Carolina, for example, the Supreme Court there stopped second-parent adoptions so that lesbian or gay couples, same-sex couples, are no longer able to both be legal parents of their children. Now, there's no doubt that that is an outlier ruling and that the trend is very much in the opposite direction. But I will just say, regardless of the angst we're feeling about what the hell are we supposed to do on April 15th, which, let me just note, is my birthday. As much angst as we might feel about that, we are pretty lucky to have come as far as we have in California, to celebrate how far we've come, to feel a measure of security and safety. And while he's here, and because he is going to be leaving soon, I want to recognize an individual who, from my perspective, being on the front lines, doing this work for 15 years, it is very clear to me that without him, we wouldn't be where we are in California. Jeff Kors from Kollaja, California. Thank you, Jeff, for all of your work on all of our behalf. So tonight we have several organizations who helped present this evening, really important organizations that I hope you will think about and support if you're able to. Bailiff, which is the Bay Area Lawyers for Individual Freedom, the LGBT lawyer group in the Bay Area, Equality California, the Gay Men's Chorus. Every time I see a Gay Men's Chorus concert, it makes me cry. Love them. Horizons Foundation, obviously very serious community partner supporting us and all organizations in the Bay Area. Our Family Coalition, fabulous organization in San Francisco. Our home here, the San Francisco LGBT Center. So our presenters tonight really are at the pantheon of individuals who are trying to make sense of a very complicated scheme that same-sex couples find themselves in. And we're lucky to live in the Bay Area where we have a large number of individuals who really are devoting their lives, their professional lives, to advocating on behalf of their LGBT clients in a way that tries to provide you the best advice possible in a situation where some questions, and this is hard for lawyers, and especially the lawyers on this panel, hard to be in a situation where you may not know the answer to some of these questions. And it's that not knowing that is so difficult to deal with. But we have four folks who are trying to make sense of it and trying to answer the questions at least as best we can. And when we don't have an absolute answer, at least give you some options. So the folks you're going to hear from tonight, and they'll be introduced in greater detail later, but I just want to make clear, these are individuals whom I have such tremendous respect for, and I am so grateful that they are there standing with NCLR and other organizations side by side on behalf of our entire community. Pat Cain, Deb Kinney, Chris Kollaja, and Karen Stogdill. So you'll hear from them tonight. I hope you'll get your questions answered, and if not exactly answered, at least have better information than when you walked in. And thank you so much for being here this evening. Pat?
Cain. I am a law professor at Santa Clara University. I moved here in 2007 from the University of Iowa, where I had been for 16 years, in order to get gay marriage. I like telling that story. My spouse, Jean Love, also a law professor, is here with me, and we did get married. And then, of course, we went back to visit in Iowa, where we are also married. So it turned out rather nicely for us. I've been working on these tax issues for a very long time. I've been teaching since 1974. I started at the University of Texas, so I understand community property, which is really helpful now that I'm in California. And there are many, many, many interesting questions. And truth is, we finally do have some answers. And that's really the good news. I'm going to give you a short introduction, and I'm going to go ahead and tell you a little bit about the other panelists who will then come up and do a presentation, and then we'll take questions and answers at the end. So I'll start, and then the second person up will be Karen Stogdill. And she is a tax return preparer par excellence. She and I have visited, we've been on panels together, we've visited about these issues a number of times, and I accuse her now of being a constructive lawyer. She thinks about this stuff so well. Next up will be Deb Kinney, who is actually a lawyer. And she knows a lot about community property and has been dealing with these issues. I've been on panels with her before as well, and shared many, many email correspondences with her. And then comes Chris Kollaja. I think I actually met you first at an ABA tax meeting in San Diego some years ago, where we did some panels on this issue, even back before 2007, before I actually moved to California. They are all experts, believe me, and they ask me hard questions, which just makes my life very, very interesting. Now, I'm going to tell you why it is. Actually, all of my law professor friends say tax is finally paving the way to equality. Because the IRS, by recognizing and dealing with these issues, is beginning to see how strange this all is. And I would never have thought that tax was going to lead the way to equality until I learned that Kate's birthday is on April 15th. Now I'm convinced that will be our savior. I'm going to tell you a story. In the beginning, and the beginning was 1913. That's when the modern income tax was enacted. In the beginning, there were no joint returns. A husband filed a return if he had income, and a wife filed a return if she had income. We could file joint returns, but we have a progressive rate schedule. If you imagine the first amount of income is taxed at 10%, and then the second amount of income goes up to the next bracket, 20%. If a husband has income and a wife puts hers on top of it, she's paying way too much in taxes. So husbands and wives tended to file separate returns. There was only one rate schedule, and there were no joint returns. Then along came two key cases that were litigated in the 1920s. Both of them decided in 1930. The first one was Lucas v. Earl. Now, I'm not going to go off into great stuff here because you're not a law student class, but after you hear this, many of you are going to want to go to law school. Lucas v. Earl, Mr. and Mrs. Earl had an agreement that they would pool their income, that all of their property and all of their income would immediately be vested in each of them 50-50, equally. So they thought that Mr. Earl should report 50% of the income and Mrs. Earl should report the other 50%, splitting it so that they're both taxed down at the low bracket of 10% rather than having everything be taxed at the higher progressive rate. And the IRS said, no, you cannot by private agreement assign your income to someone else. That case went to the Supreme Court in 1930, and the Supreme Court held that's right. You cannot by private agreement assign your income to someone else. 6 months later, probably the most famous case in early tax history, Poe versus Seaborn, came to the Supreme Court. It involved a husband and wife in a community property state. Washington was that state. And they said, well, the state divides our income 50-50, and so we think Mr. Seaborn ought to report 50% of his income, and Mrs. Seaborn should report the other 50%, thereby getting that break of moving income from the high bracket down to the low bracket. And the United States Supreme Court agreed with them. So we had a separate rule for community property spouses and non-community property spouses. And that was a big deal and a good deal for community property spouses. They were paying less in tax than people in Georgia and Iowa and other non-community property states. And there are only a handful of community property states. California was included. A separate case dealing with California taxpayers went up to the Supreme Court after Seaborn, and the court held the same way. So the law has been very clear since 1930 that community property is owned from the very get-go by the two people in the community. And as a result, each one of them reports 50% as his or her income. That's been the law. It's still the law. Poe versus Seaborn has been cited consistently over its 80-year history. In 1948, we got joint returns. Now that kind of minimized the importance of Seaborn for spouses in those community property states, because most spouses reported jointly. They gave a lower tax rate. It's easier to aggregate your income and expenses on one return and report it. So that's what most spouses did. But Seaborn still applied. If you got divorced mid-year, you would have to file single at the end of the year, and you'd have to split off your community income for the period you were married. So it's still applied to spouses. It's never not applied to spouses. So in 2005, when California adopted true community property for registered domestic partners, a number of us in the legal academy said, this is really interesting. I bet they didn't think about this, but Seaborn is going to apply, and now registered domestic partners in California are going to be able to split their income 50-50, and they're going to be paying lower taxes than same-sex couples in any other state, just like the spouses in the days before the joint return. And I think all of us on Tax Prof, which is a listserv of tax law professors, agreed with that, except maybe one or two outliers. But the important thing was the IRS didn't agree with us. Now, you're going to hear more about that from Karen. But the IRS didn't agree with us. I wrote a brilliant article, explained it all. IRS came out with its own, it's an internal memo. It's not really a public rule, but it's an internal memo, a CCA, Chief Counsel Advisory, that said, no, registered domestic partners can't split their income. Why? Well, they just can't. I mean, there was really no analysis in it at all. Seaborn has ever only applied to married couples. And all of us in the academy argue, well, Seaborn's not about marriage, it's about property rights. That's what it's about. And finally, in 2010, the IRS, I like to think, finally saw the light and agreed with me. Not just me, but a lot of academics. And so we know one thing for sure, and this is clear. The outstanding authority, the strongest authority, is a 1930 Supreme Court case, Poe versus Seaborn. It says you split your income 50-50. It says, therefore, you split your deductions 50-50. We've got 18 years of history, tax history, from 1930 to 1948. Rulings, cases, dealing with spouses, answering a lot of the questions that we are now asking in our community. So there's law out there. And we've been researching it, and we've got access to that law. And, maybe the question's not always answered exactly, but we actually know the law better than the IRS. I mean, I have been in email contact with a number of people at IRS, and I'm giving them information and answers. I think we are really, in fact, I think in this community, with these experts, and actually everybody on our listserv, basically, who prepares tax returns, are all experts here, and we're really lucky because of that. What do we know for sure? You split income, you split deductions. The other thing that was answered for us by the IRS agreeing that Seaborn applies are a number of important gift and estate tax questions. If the property is owned from the get-go, 50-50, there are no transfers. So a wealthy partner, really wealthy, earn $10 million a year. I hear some people do that. Is really vesting $5 million of assets into his or her partner, and it's not a taxable transfer for gift and estate tax purposes. At death, the entire community estate, that means it's going to be acquired during the marriage, and Deb's going to talk more about the community property rules, but the entire estate is split 50-50. We know that for a fact. And I'm fairly certain that when a support payment is made in any state where the relationship is recognized as a marriage, as a registered domestic partnership, or as a civil union, when one partner is required by the state to support another, that can't be a taxable gift. We have a ruling that says imposition of support obligations by the state do not create taxable gifts. So by analogy, and it's not about marriage, it's about state property law, rights and responsibilities. And the IRS and the feds have to rely on state property law. They don't have a whole federal system of property, so they rely on state property law. They treat each state differently according to the property law. They recognize joint tenancies and tax the income from that, 50-50, or a tenancy in common. So of course, they should be recognizing the community property regime. And at last, they're doing that. So I feel very relieved that we now know the first answer to the question. Seaborn is the starting point, and that tells us a lot of answers to the rest of the questions. I think we should embrace this change by the IRS, and I think that we should be happy that a lot of people are going to be paying lower taxes in our community. It's not a benefit they intended, but they understand that it's there. And I think in the end, we'll all be better off, and tax law will lead us to equality.
So my name is Stogdill, and I have a tax practice here in San Francisco and also in the East Bay. And as you can imagine, you can see now why Pat was convincing to me that Moe v. Seaborn was the law and should apply to us, as well as to Chris and Gene Johnston, who wrote an article on it back in 2005. So I get to tell you the history of why we get to now, we get to take a ride on this stuff. Income tax gravy train, as I like to call it, at least for a lot of people it is. We get to ride on it because we live in California. And because of organizations like NCLR and Equality California, who got us registered domestic partner rights. And on January 1, we had the registered domestic partners right in January 1, 2000. But on January 1, 2005, effective January 1, 2005, is when we got community property rights from the state of California. And if you were already a registered domestic partner at that time, like I was, you got that letter from the state that said, okay, we're really serious now. We're going to give you real rights. And if you don't want this, if you're really not committed to this relationship, you can just write us a letter and say, we're done. Otherwise, you're really in community. You are in a legal community with your partner now. And what that legal community meant was your earnings were equally earned 50-50. If one of you worked and made all the money, and you made $100,000, my wife, if I made $100,000, $50,000 was hers the minute I earned it. And if we dissolved our relationship, she got the $50,000 or whatever we had acquired with the $50,000. It was like, this is really serious, this is really commitment. And if you didn't want that, you can do a prenup. You could have done a prenup at that time. If you're really scared right now, you can do a post-nup. You don't have to get divorced. You can do that too. You don't have to. So we got 1/1/2005, California. We got community property rights, and when they gave it to us, not only did they give us community property rights, but they gave it to us retroactive. So if you had registered in 2001, your community property rights started on your date of registration. So really, really wonderful benefits. So we were convinced at that time that, in fact, we were going to have to do what we're having to do for income tax returns now. And it's a lot of work, I have to tell you. And we were kind of nervous about it, and a bunch of tax preparers were all meeting, and frankly trying to figure out how we were going to get out of having to do it at that point. And we were asking the IRS these questions. Does Moe v. Seaborn apply? Do you agree that this is the proper analysis of the law and that we really need to split our income? And we thought we were going to have to do this for 2005 tax returns. IRS was silent. They wouldn't tell us anything. We said, a couple applied for a private letter ruling. The IRS was silent. And then we asked for a revenue ruling. The IRS was silent. Finally, it was February of 2006, and the IRS came out with one of these internal memos that Pat was talking about. It's called a CCA. It's a Chief Counsel Advisory. It comes from the highest level of the IRS, and it's their internal memo. It's their national office telling their IRS field offices, people in these situations need to file their tax returns in this way. And when you go out and you look at their tax returns or you audit their tax returns, these are the standards that you're going to be auditing by and judging them by. Did they comply with this? So this is the communication that we got. So it was that one was the IRS 2006-08038, and it said ignore community property. It said keep doing what you've always done. Put my $100,000 W-2 on my return. It doesn't matter that $50,000 is really my wife's. Just keep doing it. Now, Congress didn't really have, IRS didn't really have any law behind them to do that. So we all thought it was wrong at that time. California understood that it was wrong and that in order to get right, they would need to pass a special law, which they did. So California passed a law that said, yes, it's community property, but for state income tax purposes only, put it on your own tax return. So that's what we did for California for 05-06, and that was under California law. For 05-06 under federal, they just said ignore it. Actually, up until 2009, they had just said ignore it. Now, you remember in 2007, we got the joint California tax return, and that was all solved because now they're treating us as if we are married in California. But from this point forward, we didn't think this was right, and in fact, there's several couples, clients of mine now, who did not think this was right, and their attorney, Don Reed, they're a gay male couple in Berkeley, their attorney had applied for the original private letter ruling with the IRS. And that's where you go to the IRS, you put out your situation, you say, this is what we think we ought to do. Will you tell us whether you think it's right or not? And the IRS can tell you, or they can say, no, we won't tell you. Previously they had said, no, they won't tell you. Now, the 2008 elections, though, brought us a new administration to Washington and a new administration to the IRS, because the top levels of the IRS are all political appointments. So we thought it was a pretty good time to resubmit our same private letter ruling, which my clients did. So they resubmitted their private letter ruling, and then we waited. And right after tax season this year, on May the 5th, they got their private letter ruling back. And their private letter ruling said, Professor Pat Cain is brilliant. She's absolutely right. OPC board is the law. Not only, you get the next one, not only can you split community property, but you must split community property. So this is the IRS Publication 17 for 2010. These are the specific instructions where it says for California, Nevada, and Washington, domestic partners, because those are the three states where we have both partnership recognition and community property rights. So in those three states, you must report half of your combined community property income on your two tax returns, see Publication 555, and then they're just starting to come out with the new forms, but they've already come out with the instructions for the 2010-1040. Now, the original PLR and the CCA didn't mention same-sex married couples. We knew that same-sex married couples in California have the same community property rights. And it's not about the relationship, as they were saying. They're not recognizing your relationship, whether it's a marriage or a domestic partnership. They're recognizing that you have community property rights. Same-sex married couples have the exact same community property rights. So whether you're only same-sex married, or whether you're only registered domestic partner, or whether you're both, you must split your community property income, beginning with your 2005 tax return. 2010 tax return. 2010. Let's see, I'm getting ahead of myself. Go to the next slide. So then the next slide said, not only, they didn't quite say it in these words, but basically they said, and you were right all along, Pat. So not only do you have to do it for 2010, but if it would be to your benefit, you may go back and you may amend 2007, 2008, and 2009. Okay? Okay, so you can amend 2007, 2008, 2009, but you don't have to. It's not required to amend. If you do amend, both spouses must amend. And for many people, and this is very important to know, you can amend usually 3 years if you filed on time in 2007. So if you filed any time between January the 1st and April the 15th of 2008, it would be when you filed for your 2007 tax return. Your statute of limitations to go back and amend that will end April the 15th. If you extend it and you file April the 17th, your statute will end April the 17th. August the 28th, it'll end August the 28th. So we've got a limit on the 2007. So if after you leave here tonight you think, hey, there might be money for us on our 2007 return, you need to deal with that right away. In fact, probably put your 2010 on extension and go get the 2007 money. Because the 2010 money will still be there. It's not going to go away. But you got to deal with the 2007 if it's going to be to your benefit right away. So let's do some examples. Could it be to your benefit? How much? These are actual tax returns that I have amended and filed. And these numbers on the far right, the two left-hand columns are the taxable incomes, not gross income. So that's taxable after you've taken your deductions, right? Your mortgage, your state income taxes, your charitable contributions to Equality California, NCLR, our family coalition. So if your taxable incomes were like these two columns, this is how much these couples save per year. I have couples that have already gotten back $60,000 and more for 3 years of amended tax returns. Now, if they tie 10% to the charity, we're doing pretty good on the charities too. So, $34,000, $22,000 per year, somewhat. You can see those years, those taxpayers had losses that got released because they didn't have income on their tax return, but once we gave them income from their partner, they did. I hesitated to put this up here because it's so variable. It depends on every single thing on your tax return. It's really hard to just look at a tax return and say, yes, you will benefit, or no, you won't. There are a lot of factors that are determined whether you will. But you could, the first thing you can do, at least look at your taxable income. So if your taxable income amounts are far apart, it's likely you'll benefit. Because in Pat's example, you're taking income from a high tax bracket, you're taxing in a lower bracket. Not always the case if your income gets too high, though. I had somebody with 750 I thought, oh, great, we're going to get a bunch of money. They both went into AMT. They actually would have owed more. So it's really, really hard to say absolute loss. You really have to look at all the numbers. But there could be a lot of money out there that we need to go and get before. For 2007, we need to get it pretty soon. 2008, 2009 are still open for 3 years. So all of this, as you can see, all depends on what your community property is and what your separate property is. We haven't talked very much about separate property. And the attorneys are going to explain this because they've been dealing with community property and separate property forever. But basically, I'm going to give you a really easy example of community property and separate property. So when my wife and I got together, before we got together, my separate property was the fabulous motorcycle that got her attention to begin with. I love it. It was mine. It's my separate property. It's not hers. None of it is hers. She, on the other hand, was living in Berkeley and had this fabulous piece thing. It's quite that wonderful, but she didn't have a van, as a matter of fact. She paid for it. It's her separate property, right? Okay, so we get together, we become registered domestic partners, we later get married, we earn earnings. Okay, we have to get a bigger motorcycle, put all our stuff in the bed, and the back of the motorcycle. And now we got this big trike. Actually, I don't have that yet, but I see my future ahead. So we're buying this with current earnings. Our current earnings are community property. All of that is community property. So that's sort of a very quick example. Now, those don't actually appear on my tax return. So in fact, I actually don't even care about that right now. But I'm going to turn it over to the attorneys, Deb Kinney, the consummate attorney, who will talk to you about what is and isn't separate property.
So good evening. I'm Deb Kinney. I have a law practice here in San Francisco and in Santa Rosa. And I do mostly estate planning, trust administration, and probate. But interestingly enough, family attorneys are sitting here going, oh, no, don't want to have to go in and figure out what's community property and separate property. The accountants are like, oh, no, I can't tell you what's community property and separate property. But in estate planning, we really have to deal with community property and separate property. So I think that's why I got lucky enough to sit on this panel tonight with my esteemed colleagues. So, the question is, when do you care what is community property or separate property? Historically, you don't care until either divorce or death. The rest of the time, you're just trying to earn a living, sneak an extra week of vacation maybe, get the kids to school on time. But the nature of what your property that you're earning is really one of those silent subjects until it's no longer silent. And having said that, heterosexual, opposite gender, federally recognized married persons. If we don't have anyone in the room, I'd just like to call them frumps for short. And it's said with no malice, but it's an easier acronym. But they have this, the tax code works fully for them right now, and so they don't really need to keep track of what is their community property income and their separate property income for tax purposes. So most of your friends who are frumps really don't, on an annual basis, analyze what is community property and separate property. They do during divorce and they do during death. So if we go to the next slide, what I want to do is I really want to stress the importance of trying to figure this out. Now, historically, divorce is the time where these conversations are very heated, and you don't get a lot of cooperation. At death, it's much easier to work with a surviving spouse to figure out what is community property and separate property. And then what we're doing is we're going to be having income tax conversations as well. And I bet there's going to be a number of you that walk out of here at the end and say, ugh, there's no way I could ever figure it out. Just call everything community property. Just split it 50-50 and let's be done with it. But I really want to underscore the importance of making that a conscious and thoughtful decision if that's really how your statistics and facts play out. Think about if you sign your federal tax returns for the next 7 years declaring that all of your income is community property. And then your wife leaves you for the pool girl in Palm Springs and you're not very happy about it, all right? Well, at that point, if you've signed under penalty of perjury that all of your income is community property, I think you're going to have a very hard time convincing not only your attorney but a judge that in fact those assets weren't really community property. Okay? So, now that I have your attention, let's try and figure out how are you going to figure out what do you need to know before you get to your account. First, you need to understand community property and separate property, all right? So we can go to the next slide. Community property is property, it's basically property that you earn from your day job since the date of your registration or marriage, whichever is earlier. Okay, now for many of you in the room, I'm going to bet, how many people here were registered in 2000? Oh, wait. How many 2001 or 2002? Yeah, register. You couldn't get married then. Okay, so 3/4 of the room, okay, have been registered for over 9 years now. All right, and now the IRS is saying, oh, by the way, we'd really like to know what's community property and what's separate property for the last 9 years. And life is fast. You make some money, you throw it in your joint account because you got to pay a bill, there's an extra roof that needs to be put on, somebody transfers money from a savings account into that account. Very few of us have kept track of what's going on. So technically, what you want to do is you need to figure out what you've earned since the date of your registration, and then what you've actually saved and invested, and which assets you've acquired with those earnings. And for some of you, it's going to be fairly simple because some of you still keep separate bank accounts, even though they are community property, you pretend like they're not. Some of you have never kept separate accounts, but you make about the same amount of money. Some of you are that's the entire gamut of people, I promise you, sitting in this room. So the question is, what are we going to do? So it's the income that you earned from your work, basically, since that day. And then any property that you've agreed to convert from separate property to community property. And anything that's not identifiable as separate. Now, separate property actually, let's see, I'm jumping ahead of myself. I switched it on here. Average community income. All right. So So we've done that. So let's go on to the next slide. Separate property, okay, is gifts and inheritances received at any point. Prior to registration, after registration, doesn't matter. Especially as long as you keep them separate. Once you start commingling them with community property, once you start putting your partner's name on them, once you start doing other things, then it becomes more questionable as to whether it is truly separate property or not. And those facts usually only come out in a litigated divorce. You may be able to trace some of it. It may be that you received a $100,000 inheritance, and that's what you put into the kitchen. And so you know that you put $100,000 into the home, and it's very clear. Often it's not quite that clear. And the income, separate property income, is income from separate property assets. So if I have my 2 units over in the East Bay that I owned a long time ago, and I have renters in there, that income is my separate property income, all right? Because I never put my partner's name on the title. And I don't spend my days managing it. Every now and then I have to go do repairs, I have to hire people, that's fine. The income from my day job is my community property income. If I received an inheritance from my father that was $100,000 and that's in an investment account, all the income off that is my separate property income. All right? So this is what you're going to have to figure out, hopefully prior to meeting with your tax preparer and or prior to you doing your own taxes. Now, how are you really going to figure that out? Sounds good. But for those of you who've been registered since 2000 or 2001, I know you're about ready to walk out the door right now and probably move to Iowa, which is where you can be married with no community property. Actually, you won't go there in the winter, so you're going to have to do your taxes anyway. So basically, I think what we're going to have to come up with is some very reasonable, defensible, articulable way that you came up with these numbers. All right? And there's many ways to do it. For some of you, it's going to be pretty clear, and there's going to be one muddled account. And you're going to be able to figure out overall, over the years, how much went into it. For some of you, you may have contributed proportionally to all of the expenses over the years. You can go back and look at what you've earned over the years and figure that the net left over is how you contributed to your joint accounts. And it may be that I own 1/3 of those accounts and you own 2/3 of those accounts. That's going to be prior to your community property, prior to your date of registration. I think that the tricky part is going to be figuring out what's your separate property from before and then what has been added after. Okay? And then the most important thing is that you're going to have to come up with some sort of agreement between the two of you as to what works. Because we can't look at one account and I can't say I remember it being 75% mine and take 75% of the income as my separate property, and you too saying you remember it as being 75% yours and taking 75% of it as your income. So you're going to have to come up with some agreement between you, and I think that that's going to help not only with your taxes, but around your property ownership and being able to identify it on a go-forward basis. Is there anybody here who just registered recently? Or got married recently? No. Oh. I was going to say, I have a very simple solution for those people, but I guess it's not out. Since we're on webcast, though, let me add it. I'm actually telling people to take snapshots of all their accounts right around the time they're registered, and then to even sometimes start a separate account now for their community property income. And if it's that easy, then they can keep it clean. All of the interest income, the 1099s, everything else that come from the certain accounts, that'll all be their separate property income. And then their joint accounts, or however they want to hold their accounts on a go-forward basis, will be community property income. So there are some solutions to simplifying. If we had noticed 10 years ago, it'd be a lot easier. So I think with that, I'm turning it over to Mr. Kollaja, who's going to tell us how we're really going to get these returns done.
Hi, I'm Chris Kollaja, and I am a local CPA. My firm is A.L. Null & Company, and we do pretty much the whole gamut in terms of accounting, both audits, taxes, most things that accountants and CPAs do. Tonight, I was asked to talk about really kind of the nuts and bolts of how do you go about preparing a tax return with this under the new rulings. And so the idea is to try to give people, I think we're going to keep going. Yeah, just go a little further. We'll get to it sooner or later. So under the two rulings, what we find is that that we are now required in 2010 for this year, this tax year, to file under the new rulings. There was some debate about it, but what our sources at the IRS said that verbally that you must file, and now with publication 17 and also the instructions requiring it, I think it's gone away in terms of some question about it. So I believe that for 2010, if you have community property, you're required to observe the new rulings. We also think too, as we talked, that it also applies to same-sex marriage. You know, the rulings themselves, when they discussed the rulings, they discussed it based upon the property rights. They did not base it upon relationships. So I believe that if you're not registered but you are married, just as I am not registered but my partner and I are married, that we file based upon the new rulings. When you go to prepare your returns, one of the big things that you have to do is look at publication 555. And in that publication on page 2, it says that this does not apply to registered domestic partners. But if you look at the bottom of the page, it said that the publication was revised in May of 2007. And so you have to, if you get an old publication 555, you have to just disregard that paragraph because it does not apply. That paragraph does not apply. However, it is very critical to file using the method they talked about in this publication. You're likely to get your return rejected or have significant correspondence if you don't follow the rules under publication 555. This publication is actually a must. I have to say that it has some very good information in it. It has a chart that describes community property. And we're going to go into each of the types of income and each of the types of deductions and talk about how do you determine community property for each of those types of income. But as you know, that community property income starts at the date of registration or the date of marriage and terminates or ends at the date of divorce or at death. That's really significant because if you were a boyfriend, if you were boyfriends or girlfriends, up until the date of registration, you don't have community property. You don't have community income. And so if you register during the year, you have to split that year. Portion of the year is a separate property, and the remaining portion of the year is community property. So you'd have to separate that year and calculate it separately. Also, if you happen to go out of the state of California to another state that is not a community property state, during the time that you live in a non-community property state, you're not subject to community property. It's where you're domiciled or where you live is by the workings of that state determines whether you have community property or not. Also, a lot of us have commingled accounts. We have accounts that we're not really sure of. I think the thing is that, as Deb was saying, that we have to go back through and kind of do an analysis, a reasonable basis, to try to determine what is community property and what is not community property. Why is that important? So let's get down to that. If you have a bank account that's earning interest income, how much of that interest income is community property? So you'd have to determine what principal, the amount that's in the account, what portion of that is separate property and what portion is community property. And the thing that is really critical, because Deb highlighted this, and I think it's really critical, you can't speak out of both sides of your mouth. You actually have to, if it applies for taxes, it applies forever. It's not, oh, well, let's just transfer it this time, this year, and we'll transfer that to another. You cannot do that. The IRS will find that you have a varying allocation or sharing, and that they'll question whether, in fact, that allocation is correct between the two partners. So it's really important to determine what, like Deb says, take a snapshot or determine it on a reasonable basis how much in each one of these bank accounts or stock accounts is separate property and how much it is, and be consistent in the way you treat that from year to year. Oh yeah, this is the chart that I'm talking about. This is an excellent chart because it goes through each one of the things that Deb had talked about, which is that if you have community property that was acquired during the marriage, or while you're domiciled in a community property state, that is community property. And then it talks about community income, which includes most things like wages, salaries, pay for services, and then also real estate that is community property, income from community property. So for example, when you start using this chart to determine income, if you had dividends, interest, or rents, you have to look to where they were earned. And if they were earned by property that was community property, then it's community income. If it was earned that is separate property, or like, for example, I have a rental property that I had before I had gotten married, well then all of the rents would be separate income. All of the earnings that I earn out of my practice as a CPA, that is because I'm married, that income is community property. I have to split it with my partner. If I have salary, I have to split that. Now, one of the things that's interesting is that for salary, the withholding is split as well too between the two partners. But, here's always these buts, but for me, because I'm self-employed, I have to make my tax payments. And because I make those tax payments, I can't transfer half of those payments to my partner. He actually has to make the payments too. He didn't like that too much when I asked him. So he got his way in the long run. One of the things that is important is looking at also the deductions as well too. You know, one of the things that you have is when I think of assets, I think of, we got three pots, hers, theirs, and hers, okay? And so you have these three pots, and sometimes the pots are empty, you know? That you didn't have any separate property on either one, or that you decided that everything is community property because y'all got together when you're very young and you didn't have any assets. And so if money is coming out of the joint account, and it is community property, and it's paying for charitable deductions, or it's paying for mortgage interest or real estate taxes, it's likely to be split 50-50 because it's presumed coming out 50-50 out of a community property account. And so for when you get to your Schedule A, your itemized deductions, it's more likely that you'll split those 50-50 because the deductions were paid by joint or community property. One exception is that if you have separate property, for example, if you owned a rental property that was separate property and you paid the expenses of that, that would be separate property deductions. If you have a separate house and that you had a residence that was owned by one person, and so subsequent the deductions or the cash that was used to pay the deductions on the mortgage interest and the real estate taxes, those would be split, believe it or not, between two parties, in my opinion, because a community source, the payment of the deductions was made by a community source. So what's interesting is that my partner and I, when we got married, I owned the house. But now, even though I own the house, we split the mortgage interest and the real estate taxes because it was paid with community property. It was paid with money that I earned and he earned, and we pay that mortgage with that money. One of the things that is going to be also important is that when you prepare your return, your federal return, you're required to actually show how you split the income line by line. So you're supposed to attach a spreadsheet that shows how you split this up. Now there's an example. There is an example in publication 555. Now, if you don't do this, your return will get rejected. So it's really, the reason that we use publication 555 is because when we file returns based upon how they tell you to file it, then you're less likely to get rejected. Now, what we have found when we filed the amended returns and we have filed current returns for 2009, at the very beginning, the IRS started having problems accepting these returns because what we found out is that we might file the return in Fresno and then it gets shipped off to New York or it gets shipped off to Memphis in another processing state when they apparently were overloaded at Fresno and the other processing centers didn't know about this. But I believe that now the IRS the word has gotten around, and so these filings are now being accepted. There's likely to be correspondence about penalties and interest, but there's a good reasonable cause that if in fact you file these returns and you owe money, and the IRS wants to assess a penalty, you can say that you're filing based upon this ruling, and because of this ruling, the penalties can be waived. So don't just because you get an IRS ruling, an IRS letter or correspondence, I would not necessarily pay that until you at least request an abatement of penalties. And I understand that just recently the IRS is trying to prevent that from even happening. So hopefully that will happen in the future. Okay, thank you.
Okay, we're going to switch to question and answer. I'm going to ask everybody to come up on the stage so they can all face the audience. I'm going to make a couple of comments on some of the things that were said. Chris gave an example about when you pay with community funds, then you split the deductions. Poe versus Seaborn wasn't about that, but the cases that followed raised that issue. And so the principle is just a principle of consistency. If we're going to split the income, we're going to split the deductions. And let me just give you one case to show you how far they go with that. A husband owed alimony to his ex-wife. It is paid with community income with his new wife. The new wife gets a deduction for 50% of the alimony to her husband's ex-wife. It isn't her alimony, but that's the court said, and these are court cases that are authority, and the court said it's the only way it makes sense, because we have to split the deductions to go along with the split of the income. And it's true, the IRS, the right hand doesn't know what the left hand's doing, but that's not new. That's been the problem for some time. But we've talked to a lot of cooperative people there who are trying to help us and help the IRS get it right. We got some questions in advance. We tried to answer most of those in our presentation. I'm going to answer one or two quick ones and then pose some to the audience and get yours too. Somebody asked if we're registered earlier, but now we're divorced. Can we go back and amend? Well, sure. If you were married and subject to the community property regime in 2007, 2008, 2009, that's the law that applies to you, so that's grounds for amending it.
Pat, on that question, what was asked, and I just want to highlight this because I talked to Deb about that. So you're you're in a divorce. Now this is water under the bridge at this point. But let's say you're working towards a divorce right now. The important thing to know is that in your property settlement agreement, you may very well want to have an agreement that no party will go back and amend. This is common in most straight divorces, that they agree on the tax filings, how they're going to file. So that question actually, to me, has is very relevant to the question of how you getting, if your divorce attorney is in the straight community and is not aware of these type of filing requirements, then it's imperative that you bring them to one of us to kind of enlighten them on what needs to be included in the settlement document.
Anybody want to add to that? Okay. I have another question that involves Social Security, and I just wanted to say this up front. We don't know about Social Security, whether it's community or separate. We don't know for sure. We do know that at the time of divorce, we have California case law that's very clear that says it will not be treated as community property for purposes of splitting the right to future payments of Social Security. That's what the California court says. But the IRS says state law controls whether Social Security is community, and the IRS position is that it's whatever the state law says. So there's a strong argument, because we have such a strong presumption that anything you receive during a marriage is community. So if you rely on that presumption, it's going to be hard to rebut and say, well, Social Security isn't, because there's no authority out there that says that. On the other hand, every family lawyer I've talked to some community property experts as well, Herman O'Kay at Berkeley and Grace Blumberg at UCLA, and they can get on board with the presumption of community property. But every single family lawyer I've talked to says, no, Social Security is not community property, and we won't be taking that position. So I think you've got a reasonable argument either way. Just be consistent.
The disadvantage of, in my opinion, the disadvantage of treating it as community property has, I think, some disadvantages. First off, when you go to calculate self-employment tax and you calculate withholding tax for Social Security, it is done on a separate basis. It's not done in any sort of community property basis. So and then secondly, there is no benefits to registered domestic partners or same-sex married spouse with respect to the death of one spouse. So I'm not sure that this case law is well developed for you to treat it as community property and strong enough to be community property. So just be leery if you're going to take that position. Just know that you have some risk involved in whatever position you have.
But I don't think you'd be subject to a penalty
Relative to
lack of a clear law.
Let me give you a measure of risk just for a moment. To me, when I think about community property, I don't worry much. But when I worry about a second dip in the economy, I worry a lot more. So that's kind of the relative thing. I just wouldn't worry. I would try it, and I would say that it's a reasonable basis.
We also are accepting questions from the web, and I think a lot of these actually are probably questions that you guys have too. So I'm going to run off a few of these.
Oh, are you? Okay.
And then we'll go to you. Will TurboTax and other programs be able to do your tax return? Probably not. Right now, H&R Blog Online says go to an office. Right now, TurboTax says they're waiting for the IRS to issue an update to Pub 555. So I checked them today. We're not sure we're going to get an update to Pub 555. We believe the only update we're going to get is they're going to take a paragraph out that says it doesn't apply to you.
Yeah. I've been told by the person at Forms and Pubs that he can't redo Pub 555 in 2011, but he's going to do an overlay on the web. I've been asking for more guidance, and I'm still going to keep asking them to provide us with more guidance, but they'll at least take off the old language.
One thing we didn't
remember that on the tax software, it does just the return. There are still attachments that you have to attach that have to be hand prepared, required under Publication 555. Included, they like to have both W-2s on both returns.
And as of right now, we're told that you cannot e-file these returns. No one, anywhere, whether a professional preparer or anybody else, because you have to make these attachments, and these attachments are not e-fileable. We were supposed to have a conversation with the IRS this morning, but they said it snowed, although my spy in Arlington said you had to have a microscope to see the snow. But I did live in D.C. for a couple of years, and it pretty much closes down when they get a little bit of snow. But we're trying to get them to allow us to e-file, but it's doubtful that we're going to be able to.
Why don't you just highlight how you prepare that return in terms of line 21.
Okay.
But there's no reason not to use your software and e-file your joint California return, right?
Right. You can still file your joint California return the way you've always done. So you can prepare the federal pro forma. You can prepare your joint California return. You can e-file that, and you can do it tomorrow. if you have your documents, because my understanding is California is out of money. And we will probably have all of these a lot sooner than
But
we
on the
had.
software itself, it will split the income, but what we're concerned about is computer magic. And so, you have to remember that these returns go into the computer, they're checking against what you're reporting and what they receive from 1099s and W-2s. So that schedule is very important to attach.
Now you're talking about the federal.
Right,
Yeah.
but the whole point of the TurboTax and the others, they're good programs, they're very good programs, but just be aware of some of these limitations and how they present the return.
So you're just going to have to keep checking back with them. This is real early in our.
Okay, first question here, yeah.
Yeah.
Oh, no, I'm sorry, that woman behind you, she had her first. We'll come back.
Aren't we getting a tax advantage?
Yes,
Okay.
most people are.
No, but aren't we getting a tax advantage over opposite-sex couples who are married?
Right, because they don't file as single.
This one year.
They don't,
Or
well,
however many years.
no, until Congress takes some action. Because they don't file as single, they file as married. So when they file separately, they file married filing separately, and they split everything exactly. That's what Pub 555 is for. Has anyone told them? Nothing's changed for them.
I'm sorry,
But
but
nothing's changed for them, but we have an advantage over them. I mean, don't they care?
I really think we should just kind of whisper this amongst ourselves.
It's true.
I have a follow-up
Right,
question.
down front, yeah.
Can I finish my follow-up question? I'm sorry. My follow-up question is there any way that it could be a disadvantage? Like, is there any mathematics that it could be a disadvantage?
Yeah.
If particularly if you have one partner that didn't earn very much money and qualified for credits, if you get any kind of credits on one partner's return.
I see, then it would be a disadvantage.
The other disadvantage is that you are liable under the law for the taxes on 50% of the income. And if your partner lies to you and you don't know it and you don't report it, the IRS can still come after you to get it. Community property spouses had this problem, and they had to enact a special section of the Internal Revenue Code to give innocent spouse relief to community property spouses because the regular one for joint returns didn't apply to them. And since it says spouse in the statute, so long as DOMA's on the book, I'm not sure we can take advantage of that innocent spouse. So be sure you communicate clearly with your partners about income, because there is always that risk.
And one other thing that I'd like to add when we go to that is that it's optional as to which years you want to go back and amend. You don't necessarily have to go back and amend them all. But if anybody is on income-based benefits of any kind, please be very, very thoughtful about going back and amending returns. Because if you take on half of your partner's income now and show now an income that would disqualify you or would have disqualified you from receiving those benefits, there's an argument that you may be liable for paying back those benefits. Okay, so just let's think about that.
Oh, yeah, I'm sorry.
When we filed this, I had two questions about how they work together. If I know that when married couples file separate returns, they have to either both itemize or not.
That doesn't apply here.
That doesn't apply to us.
We're filing single returns. So married filing separate rules don't apply to us. Be very clear about that.
And the other question is...
No, there was the second half of the question that she didn't answer, and is that if one itemizes, he or she probably will only get half of the deductions because it's paid out of community property.
That's the first rule.
So, so you just don't get the benefit of, we'll put all the deductions on one and take a standard deduction on the other. That doesn't work that way.
No, the other question is, suppose one of us decides to go back to 2007 and change it, and the other one doesn't.
You can't do that. You can't do that.
Is that part of the rule?
Actually,
yes, that's part of the.
I'm not sure.
They've said that very clearly. The Chief Counsel's Office has said that very clearly. I don't know how they're going to police it. They have to, but you have to provide the Social Security numbers. So presumably, it's up to them to police it. But they've been very clear.
Hold on, I'm sensing some dissent here.
It actually may be a loophole, and in my opinion, and I'm not sure why I would take that risk though, and I'll tell you why. Okay, the loophole is this: if you go back and look at community property for married folks, for straight married folks, it's required to split the income. If you go back and look at the specific language under the CCA and the private letter ruling, it says that you can elect to go back, but it's mandatory for 2010. So it could very well be a loophole. I wouldn't want to try it because if in fact you did file and you reported your income down, the IRS is they could come back within the statute of limitation periods, which is within the 3-year period, and they could assess tax for the underreporting from one party to the next, more likely from the person who did elect to amend the return because the other person chose not to. So, and then there would be penalties and negligent penalties, and it would be so expensive that I'm not sure I would want to risk that. But it's I've heard that, and I think it's possible. But I wouldn't want to risk it.
The first question of itemizing and one not, if that works out for you, is okay, or not.
Yeah, so long as you only take the one who itemizes only claims the deduction that he or she paid for with separate money or with 50% of community funds.
We have a situation where most everything is paid because one of us has almost no income compared to the other. Almost all the money would be deductions or whatever would be.
But is it community income?
Social Security checks and pension is mostly earned before 2000.
So if you take the position,
if it's all separate and it
all
turns out
if that money is
that one
deposited
person,
into a community account,
It doesn't matter where it's deposited. It doesn't matter where it's deposited. And I think that's a lot of people come and they say, but we've commingled our accounts for 20 years. We've been registered for 10. We've always considered it ours. Everything's community property. And Chris said this very clearly. That's not true. The property that you had for the first 20 years, it might be owned 50-50, but it's 50-50 separate property. Right? It's only what you were able to acquire afterwards that would be community property. I think what these guys are saying is that there's no free lunch. Okay? So we're getting closer to equality, but really what the IRS has done is they've created a third class of people. We are individuals with marital property. We're not married persons. We're not single anymore. Okay?
Oh, but I want to add something that I think is a tremendous benefit that was added here. What it gave people who registered and got married, they gave you a sense of determination at if you go through divorce or death, you have now a judicial system that can determine what your rights are. And it's determined by case law. This is a significant advancement for our community. It's marvelous.
All right, let's take another question in the back.
I have two questions. One, could you explain why Connecticut, Massachusetts, New Hampshire, etc. are not affected? And two,
they're not community property states.
How far back do you have to go for the schedule? Because if you're only liable in 2010, but if you're registered since 2001, in our example, how far back do you need to go to state your schedule that you need to submit with your return?
There's only 9 community property states, and most of them are on the West Coast and then Louisiana. So that's why those other states aren't affected. When you want to go back and determine what's your community property, you should go back to the date of your registration to find out what monies have been invested and what property has been acquired that's generating income since then.
Even though you can only do it as far back as 2007, 8, 9.
This is to determine whether the property that is income producing is separate or community, such as a bank account or real estate that produces. You have to make that determination to determine this year's income is community or separate. If you've got, and then the question is, what is the source of the payment for your deductions? So the general rule, when you've got everything in a single bank account, and if all your earnings came in and covered your expenses this year, then probably all of your deductible items were paid with community funds, even though there may be some separate property in there, because the principle for determining who paid what is if you had enough community property in the bank account, since the community is responsible for expenses, we presume the community paid the expenses so long as there's enough money there to do it. And that means the separate property is still sitting in the fund. So there are two reasons you have to make that distinction. One is to determine property that's income producing, and the other is to determine what funds you paid the deductions with.
Could you just speak a little bit to filing status? And my specific question is, I was told a couple of years ago that the IRS views us as 2 separate households. And you have children, the whole question about
definitely want to take this.
Okay, filing
status. You are not married for federal tax purposes. You are not married. You do not file married filing separately. Nobody files married filing separately for federal tax purposes. You are either single, or if you continue to qualify, and it's gotten a little bit harder, you have to jump through a few hoops. You can qualify, you can file as head of household. Now, head of household in the past, and your second question was, I think, could both of us still file as head of household? Now, I currently, and have not been for many years, letting both people file head of household in my tax return. Because technically it's possible, but it's possible if each of you have children and you're not the parents of your partner's children. So I do not have a legal relationship with my partner's children. My partner does not have a legal relationship with my children. And in addition to that, we have separate living spaces, or have separate bedrooms, separate living rooms, and we just share a kitchen and a bath. And we present ourselves to the world as separate households. We don't send joint holiday cards. We don't send these. This was the court case, and these are the things they looked at. So that's why I say I haven't let nobody in my practice has been willing to live their lives like that.
Does that mean
Even though technically it's possible. One partner can continue to file as head of household if, in order to file as head of household, you have to have a qualifying person in your household. So you have to have a child that's qualifying you or family member. And you have to prove that you paid more than 50% of your household expenses. So that's, we're talking rent or mortgage, property taxes, homeowner's insurance, food consumed at home, utilities. Now, if you have all community property income, all you're doing is working, and so you don't even have a bank account that earns interest. Then you have all community property income, and you each paid exactly 50%. So nobody can qualify for head of household. In those circumstances, you need to create separate property. So, as Deb said, gifts and inheritances are automatically separate property. And what I did, I had meetings for my clients at the end of the year and said, you guys need to create separate property. If mom gives you a $50, holiday gift check, turn it over, sign your name, say payable to PG&E, and put your account number in it, and pay your PG&E bill. Clearly, a gift is separate property. You paid it on utility. If you don't get gifts or you don't want to do that, or some people's moms thought they were playing, doing funny with the tax code and they were all nervous about that, you can create separate property. You go to our friend Deb Kinney, you go to an attorney who's familiar with these issues, and you can actually take community property and you can transmute it, like Deb said on her slide, to separate property. But it's specific language in the California Family Tax Code that has to be done. The person giving up their property has to understand they don't have to give it up. If it's your partner and you're all in agreement, you're going to get $1,500 from the IRS if you do it. She'll probably agree. But you're going to have to jump through a few more hoops, but yes, it's still possible. So it's single, or single head of household are filing statuses.
Once we became moms and we adopted, so we both were second career adoption, all that. My wife, is working full time in a 9-to-5 job now, and so she makes all the money, and I make very little money. And I have horrible debt from student loans from when I was 20. So I have a second, just a law question, if anyone wants to answer it. She was afraid she would owe my student loans. But anyway, am I her dependent? Because she did file a head of household, and I don't know what we should do about
if she didn't have children, you would not qualify for her to file a head of household. You potentially could have been her dependent. In the past, you could have been her tax dependent. In 2010, you have half of her community property income, so there's no way you have to make less than $3,650 to be her dependent.
Do I pay taxes now because now I have an income?
Yeah, you're going to file an income tax return. You're going to have half of her income on there.
But it's not the self-employment tax.
No.
I used to be self-employed, so I understand about that. So now all of a sudden I have an income that I don't pay withholding.
Right. It's your partner's income, W-2 or self-employment?
No, she's a W-2.
Okay, so your partner's W-2, let's say that's all you had. You had a W-2 and 2 kids.
Right.
Okay? You're going to take your partner's W-2 and you're going to take half of it away from her. How I do it, and this is slightly different than how Club 555 tells you. But I hate to say this, but if you follow Pub 55, you're going to get a lot of correspondence from the IRS, and you're potentially, if you use a tax program, you're going to get the wrong numbers. So how I do it, I would take your partner's W-2, and she makes $100,000, and I put $100,000 on line 7, same place it always goes on her return. On line 21 of her return, which is other income, it's sort of just a junk line, right? So then I put minus $50,000. On your tax return, I put on line 21 plus $50,000. I don't put it on line 7. And if it was self-employment, I don't put it on the self-employment line on your tax return, even though that's where it was on her tax return, because you're going to get the wrong tax results if you do that. So you put it on line 21, and we put that on there. Her withholding, we're going to take off of her W-2. We're going to put, actually, I just put half of it on her return, and I put half of it on your return on the withholding line, because there's not a line 21 for our withholding. So it's half and half. So she's going to be half of the income. You probably are going to come out big time. And if you've had that situation, you might want to amend. But the student loans you need to talk to somebody about, because you potentially do have some risk there.
Can I ask a follow-up question to that? Is there some sort of other documentation that we need to include also to show where this income is coming from a partner that has a separate tax return?
Yeah, what I am doing with the amended returns, I guess with the originally filed returns, because that's what you guys are going to be dealing with first. So let me try to narrow it down to that, because I know this is all overwhelming. With the originally filed returns, I would attach a copy of all of the W-2s. So I attach a copy of my W-2s, and in fact, I circle the W-2 income, I circle the W-2 withholding, and I put on the bottom of that page, I Xerox it, on the bottom of that page I put my name, my social security number that I took half of it, my wife's name, her social security number that she took half of it, and then I show that it totals to the grand total. And I do that of course, and I attach both of those to the tax returns. In addition, you have to attach, as Chris said when he was doing his presentation, and there's a copy in Pub 5x5, you have to attach a spreadsheet. And the spreadsheet's going to show, this is what was reported to me on a 1099 or on a W-2. And of this amount, this is how we allocated it. This much to me and this much to my wife. This is what was reported to my wife, and this is how we allocated her amounts. So, and you do that basically for most of the lines on the tax return. And you have to send that in with your tax return, which is why they can't be e-filed as well. And they can't do any of their matching. I don't think we're going to get e-filing. I mean, I hate to be pessimistic, but I don't see how the IRS could do it.
Not in the same room.
Well, not by this time. The guy at Forms of Pub says what he needs to do is create that spreadsheet into a required form or schedule, and then once that is done, that will enable e-filing in many cases.
Yeah, and I think that's going to happen in 2011 or and then TurboTax and H&R Block and all the other commercial software.
My question is, if you filed, this is regarding the state taxes, if you made no distinction between community land, community property and your state taxes, but now you're going to do it when you file your independent returns to the single, you still file two returns.
Yeah. At the federal level, yeah.
Now you're going to make a distinction. Is there a problem if you didn't do it for the past 2 years on your state return?
Did you file jointly?
You file jointly?
You're not required on the state return.
Yeah.
On state return, you're not required to identify what's community property and what's separate property.
If you're filing jointly.
If you're filing jointly. It all goes into one bucket. The numbers come out. You deal with the numbers there. So that's why we've never dealt with this issue prior to this. And that's why this is the new hurdle, is figuring out the community property, the separate property for our ongoing returns and then our amendments.
So the federal returns is just community property, not separate?
No, you will be filing your 1/2 of income. It'll be your 1/2 income of community property plus your separate property income on your return, and you will do your 1/2 community property plus any separate property income on your return. So the numbers may be different. Sir?
Coming back to community property, if you're holding offshore assets and income that are held in the form of certificate bearer bonds, and because they're held in bearer bond, or bearer certificates or bearer bonds, so whoever has that physical piece of paper in their possession or in a numbered account has control of it. how is the dear old Internal Revenue Service going to determine whether that's community property?
They can't. They can't determine whether it's community property, and unless you report it as it's required under a FIMBAR reporting requirement, they probably wouldn't know about it. But as you know, under the UBS's case, just recently under UBS, that they are pursuing that aggressively. So I just think that this is a little out of the scope of what we're talking about today, but I do think that you have more issues about the FBAR than I think about the community property. But you would still determine community property because you're domiciled in California. You would still use the same California rules to determine the offshore assets.
I have a question about the income-based benefit. My partner actually makes about 3/4 of her income as I work part-time and I go to school. So I get financial aid. So am I required to take on half or 50% of her income? Because if I do that on my tax return, my financial aid will be gone.
Okay, so the question is that if you're qualifying now for financial aid based on your own income, and now you have to split incomes, will that disqualify you from financial aid? And the one thing that we have to go back to remembering is that this is recognition of our family's income. All right, so now your whole family is being treated. That was kind of a loophole that a lot of us are using for our kids to get scholarships and stuff like that. But now the IRS is saying they give more recognition to it. So the one thing that you can think about is doing a post-nup, because you're already married, or you wouldn't be sitting in this room on a Thursday night. Wednesday. Sorry about that, but you can actually, if you need to, go and do a post-nup that would be valid on a go-forward basis. So for the year 2011, the two of you could see separate counsel, make sure that you realize what rights you're giving up. You could identify all of your income as your wife's, and you could have your current income that qualifies you. Issues, all right, are going to be that if she runs off with the pool girl from Palm Springs next year, you've given up your right to all the community property that she has earned this year. You can't have your cake and eat it too.
I want to say one thing, because a lot of people want to arrange their affairs, their personal and financial affairs, as they choose, and I respect that. But the problem that you have is that when you go to an attorney to discuss this and to say, I want a prenup or I want a postnup or whatever, you have to realize that if your partner wins the lottery, it could be excluded from it. You can also have a postnup that's very specific in terms of just this income will be included and everything else is not. And then finally, I think that the problem with this is that, one more thing, is I think that if in fact you join another person late in life, when you already have accumulated a lot of assets, you see in the straight world that the post-nup prenups are very, very much used in that. I see that commonly. So I do think that the gay community and lesbian community have to look at the fact that we're going to see prenups more often in our community, and we need to not be terribly hurt by it because it is what the advisors will be telling their clients.
So post-nup aside, technically, yes, I would have to take 50% of her income.
Yes. Yeah, and you already did for last year, so that's tricky. Okay, so down here. Right here?
Yeah, I think one of your slides, Deb, as well as the form, the 555 form blocker that you showed, there was a point under community property that talked about separate properties which has been in which both parties have agreed to convert. Can you say more on that?
Yeah, actually, it's really interesting. So a lot of people bought houses as joint tenants with right of survivorship or tenants in common 20 years ago. Those are separate property interests, even though they may be equally owned. They're not community property. So actually, as of January 1 this year, the estate tax exemption went up to $5 million. Even more surprisingly, the gift tax exemption went up to $5 million. So if there are people that want to gift some of their separate property or transmute some of their, that means change the character of their separate property to community property, it's a lovely time to be doing that.
But it's irrevocable.
It's Chris is saying it's irrevocable.
It's irrevocable.
Once you give it away, you don't get it back.
That's really significant because you know finders keepers. You don't get it back.
So now the thing that I am actually much more excited about now, and Pat and I have not exchanged emails about this, but I'd like the blessing from who the IRS respects most in our community. But is I'm happy to change equally owned assets to community property assets right now. And I don't think there's a lot of risk because of the way the CCA came out and because of other things.
Well, if you're converting joint tenancy or tenancy in common where there were equal contributions.
Correct, where there was equal contributions and it was equal.
It wasn't just paid by one person, it was paid by two people.
Right.
Then when you convert it to community property, you're not making a transfer that transfers wealth from one party to another. You're just changing the form of your already equal ownership.
But that requires that you really contribute, not that I own the house and added you as a joint tenant. Okay?
Right.
So changing the benefit of changing the community property as a right of survivorship happens to be either a divorce or death, my two favorite subjects. At divorce, we're a lot less tentative about what the return of your community property to you is a non-taxable transaction. All right? Me taking some of my separate property and paying you off is a transfer. Okay, so then we have to deal with that. It gets complicated.
You know, one of the things that I think would be handy is to always say, you know, maybe we should always have 3 accounts. One community and 2 separate, even if you think everything's community. Because there may be times that you may want to have property that's separate. Small as it may be, but you may want
Head of household.
Right.
Yeah, tell mom to send all of those checks to your separate property account and send her a thank you for get my. All right, in the back here?
Yeah, Michael.
Supposing I had an inheritance 10 years ago, inherited property, and I added my mortgage name to that property. It did not file a gift.
Don't give us your last name. How did you add them as joint tenants with right of survivorship?
What year?
10 years ago.
10 years ago.
Well, first off, let's just go back.
First of all, hire an attorney, then get an accountant, then get an IRS negotiator.
They're hiring my clients.
For a joint property, joint tenancy property, there's a poor man's will, which you can add someone as a joint tenancy, but it's not a completed gift for gift tax purposes.
Well, now hold on. If it's real estate and you've made it into a true joint tenancy, according to the IRS regulations, it is a completed gift of 50%. But intent matters. So if you really only intended the partner to get it at death, if that's your true intent, it might be good to reduce that to writing.
The other thing is it might be actually good to complete that gift while property values are low, and you may equalize the assets more. And
$5 million exemption.
You got a $5 million
yeah, but not 10 years ago.
But that's okay. We'll redo the deal. I mean, you know, I don't know what we'll do. I just say that out loud. But you know, the thing is, a little bit of knowledge is a dangerous thing. All right. So before we used to have people on our property and take them off and add them and take them off, and the counties never kind of got us for reassessment. Oh, Carol's in the room. and they never got us for transfer taxes and things like that. Then they realized that they could because we weren't legally related. And then they went after, you know, all sorts of people. I mean, so the little thing, it's grown, and now we're treating it. And I think this is going to be the same thing. But if you want to try and deal with it, you know, I think we're going to have to deal with a lot of things that have been swept under the rug or that we just didn't know better. Well, as Chris was saying, we're just trying to make our lives work.
Yeah.
And also, and I don't know whether anybody's experienced this because I haven't heard the story, but about a year ago at a state bar conference, the IRS guy from Gift and Estate announced that they had a new project starting in California and they were going to start looking at deed records to see where transfers of title occurred, and they didn't seem to be purchases, and people might get letters. I don't know whether they're going back to...
We have to record everything. We have to report it.
No, I know that. I'm just saying he didn't, but he might get a letter from the IRS because...
They can't go back that far.
Yes, they can. They can go back. If you haven't filed a gift tax, they can go back.
Filing your taxes is going to be easy.
Question about taking income from an IRA earned free
Earned pre-registration?
Yeah. We've been back and forth. Doesn't matter when it was earned, if it's an IRA. Statutorily, IRAs are considered separate property for federal income tax purposes. So if it's your IRA and you're getting the distribution, it stays on your tax return, regardless. Now that's federal income tax. If you dissolve your relationship, it may very well be community property. It depends what income went into that IRA. If you earned community property income after you registered and you put money into your IRA, a portion of that IRA is community property. So if you dissolve, there's a part that might be community and might be separate. But when you come to me to do your taxes this year, or even if you get a distribution, then I don't know, it stays on your individual tax return. For IRAs, pensions are different though. Pensions are based on the amount of years that you earned the pension. So if you earned the pension and you worked for 10 years before you registered, and then you registered and you worked there for 10 more years, half of your pension when you receive it is community and half of it is separate. It's based on the number of months while you earned that pension.
I just wanted to add, the concept there is it is community property, but there's a specific statute in the Internal Revenue Code that says distributions from your IRA, even though it's community property, will be taxed as separate property. They just changed the rule by statute. Didn't make it not community property.
And contributions to an IRA. Contributions to an IRA are the same way. You're not going to split. If I make a contribution to my IRA this year, my wife doesn't get half of my contribution deduction. That stays on my tax return too.
How about 401k?
401k is considered a pension plan, so same rules, it's the time.
What about over here?
What's the scenario where if you've lived in a non-community property state and a community property state for half, and you have income in both, how, besides the multiple forms you have to file, how do you handle it on the IRS?
I'm going to talk about. I'm going to talk about how you do the filing, but I think it's very important that Deb talks about who's the owner, because that's going to be that's a different thing. So, with respect to whenever something happens like that, whether you get registered or you move into the state or move out of the state, that date is a very important date.
So registered in California, left California, came back to California, had property in the United States.
So when you came back to California,
yeah.
So then you have to say anything I earned after that is community property. Anything before that may or may not be community property, depending on what state you lived in. With respect to the property that you own in another state, okay, if it was purchased while you were domiciled in California and it was bought with community funds, then it would be community property. And now I don't know how that other state would treat it.
How about W-2, just earning income, pure income from the two different states?
Well, that's the point. I just said that. What happened?
Part of Massachusetts would not be community.
That's correct. That is correct. And then,
but
as
if
far
you
as
live, to follow up with that, Chris, if you live in California and you work in Massachusetts and you get income from Massachusetts, it doesn't matter. You lived in California; it's community property. It doesn't matter where it's coming from.
The determination of domicile cannot always be determined. It's not that clear sometimes.
Yeah. All right, we're going to take one more question and we're going to wrap up. We will stick around and be able to answer a few more questions. We will not be helping you with your individual tax returns tonight. However, Karen, for instance, is doing seminars here at the center. I think 3 of them coming up. 4 of them. And if you want to try and do your own tax returns, and they're very simple, straightforward tax returns. And if
no inherited property,
right.
You guys are out.
Then there's a flyer out on the table for those, and then there's some more seminars that are happening, and there's a flyer for those. So if you have friends, you go home and you say, buddy, I just don't get it. You can send your friends over and see if they can figure this out as well. And thank you for being here. But let's take one more question.
Question, if you have 2 individual trusts and your assets are in the trust, titled in the individual trust, is that considered community property in California?
The source of the asset in the trust determines whether it's community property or separate property.
It's not titled.
So if it's not titled, and that's a see-through entity for tax purposes. All right, so with that, I really want to thank you all for coming, and I want to thank the NCLR, and I really want to urge all of you to make your contributions this year to your favorite LGBT organization.
You want a tax deduction, don't you?
Well, I think it's even more important than that, because we're still in the middle of a civil rights struggle here, and we're not quite to equality, all right? Your frum friends don't have to come to these seminars. So, anyway, what I'd like to urge all of you, because all of you in this room are connected to an organization or you wouldn't have gotten an invitation here, is I would like to challenge each and every one of you to get 5 friends over the course of 2011 who do not give to LGBT organizations to make a donation no matter what size. Only 5% of the LGBT community in the Bay Area gives to LGBT organizations. Most of our community gives to animals and all sorts of other wonderful things, but we forget ourselves. And so I would like all of you to make sure and to continue to support these organizations, because we've got more ballots coming up. And, you know, I just have to have a real sense of gratitude. I get to read the listserv stuff, and some days it's very, very heartening, and some days it's extremely depressing as to what's going on around the rest of the country. And those of us that are lucky enough to have these problems have to continue to carry the ball for those who don't even know if they have a legal relationship with their children today. All right, so if each of you could find 5 of your friends, it's not going to be that hard. Have a dinner party, ask them how many donate, tell them to start. All right, go on up and invite 6 friends to find 5 who don't. Okay, and then you can send emails to Chris Herman every time you get a new donor. All right, and then we'll see at the end of the year whether this really made a difference or not. I bet it really will if we all commit to that.
I don't know about you all, but I need a drink. Anyway, happy 2011, more to come. Thanks so much. You are welcome. Nice to see you.